A few months after their mom passed, Sarah and her brother sat down with a lawyer to settle the estate. They thought they knew what they were inheriting. Then the lawyer slid one piece of paper across the desk. Their mom left behind a paid off home, a cottage, and her retirement savings. On paper, almost $1 million. But before any of it reached them, the government took a bite, a big one. Here's the part that makes people furious. Canada doesn't have an inheritance tax. Everyone says so. So, how does a family hand over a third of everything before they see a single dollar? Because the tax is hiding. It doesn't show up with a scary name. It shows up in three places nobody warns you about, and together they can quietly detonate the inheritance you spent your whole life building. I'm going to show you exactly how each one works with real Canadian numbers. And then, the good news, the legal ways to diffuse all three so your family gets the inheritance instead of the CRA getting the bill. If you're new here, I'm Jay, and on this channel, we take the scary, confusing parts of Canadian money and make them simple so you keep more of what you worked for. And honestly, this might be the most important one I've made. Here's what you'll walk away knowing: how the cottage and your investments get taxed the day you die, why your RRSP might be the single biggest bomb of all, how probate quietly skims your estate, and the legal moves to shrink all of it. And stick around because the most expensive mistake in this entire video is also the easiest one to fix. It costs you nothing, takes about 10 minutes, and most people never check it. That's coming up later. Quick thing first, I'm not your accountant and this is not financial advice. Always do your own research and talk to a real professional about your situation. Cool? Cool, let's get into it. Three bombs. Let's start with the one that catches almost everyone off guard, the one that turns the family cottage into a tax bill big enough to force a sale. So let's start with what everyone gets told. And it's true. Canada has no inheritance tax. There's no estate tax either. Your kids don't get a bill in the mail for inheriting your stuff. All true. But here's the sleight of hand: the government doesn't tax the person inheriting, it taxes you the moment before you die. And it does it through something with a boring name that hides how brutal it is: the deemed disposition. Here's what it means in plain English: the day you pass away, the CRA pretends you sold everything you own: your stocks, your rental, the cottage, all of it, sold at full market value the second before you go. You didn't sell anything, but the tax bill is real. Now, only the growth gets taxed, what's called the capital gain, and only half of that gain counts. That's the 50% inclusion rate. And yes, it's still 50% in 2026. There was talk of raising it. That got scrapped. And that deemed disposition is just the first of three bombs. There's the cottage and investments, there's your RRSP, which is a whole different monster, and there's probate. Let's diffuse them one at a time, starting with the one that hits cottage country. Picture the family cottage. Maybe your grandparents bought it decades ago for next to nothing. It's where every summer happened. To you, it's priceless. To the CRA, it's a capital gain waiting to be collected. Let's run real numbers. Say the cottage was bought for $300,000, and over the years the family put $200,000 into renovations. So the cost on paper is $500,000. Today, it's worth $1.5 million. That $1 million jump in value, that's the capital gain. And remember, half of it is taxable. So $500,000 gets added to the final tax return in one single year, on top of everything else. In a top tax bracket in Ontario, that works out to roughly $267,000 in tax on a cottage nobody actually sold. The family either finds that cash or they sell the place that holds every memory they have. Now you might be thinking, wait, isn't my home tax-free? It is. The principal residence exemption wipes out the gain on your main home. But here's the trap: a couple can only shield one property per year, your home or the cottage, not both. So families have to do the math. Whichever property grew more each year is usually the one worth shielding. Most of the time, that's the city home, which leaves the cottage exposed. There are ways to soften this, and we'll get to them. Hang tight. So that's bomb number one, the cottage and your investments, taxed as if sold the day you die. But honestly, it's not even the biggest one. The next bomb is sitting inside an account almost every Canadian has, your RRSP.
Okay, your RRSP. For decades, you've been told it's the smart move, and it is. You put money in, you get a tax break now, it grows tax free for years. But here's what nobody mentions: that tax break was never forgiven, it was just delayed, and the bill comes due. Here's the brutal part: when you die, if there's no spouse to pass it to, the entire RRSP gets counted as income, not over your lifetime, all of it in the 1 year you die. A $400,000 account becomes $400,000 of income in a single year. And when you dump that much income into 1 year, it shoots you straight into the top tax bracket. In Ontario, that top rate is just over 53%. In BC, it's basically the same. In Alberta, it tops out around 48%. And before you tune out thinking this is a rich person problem, it's not. If you've got an RRSP, any RRSP, this is your account. The bigger you grew it, the bigger the bomb. The responsible savers get hit the hardest. That's the cruel irony here. Let's make it real. Margaret is 78, widowed, living in Toronto. She's got a $700,000 RRIF, that's just an RRSP turned into retirement income, plus about $90,000 a year coming in from pensions and CPP. Her home and her TFSA are going to her two kids. The day she passes with no spouse to receive it, that entire $700,000 RRIF lands on her final tax return, stacked right on top of her other income. Suddenly, the CRA is looking at nearly $800,000 of income for 1 year. Here's the damage: the tax on just that RRIF comes out to roughly $355,000, more than half of it. Margaret's kids thought they were inheriting $700,000. They're getting about $345,000. The CRA gets the rest. Now, the good news, and there is good news: if you have a spouse or common law partner, the RRSP rolls over to them completely tax-free. It just slides into their account and keeps growing. There are narrower lifeboats too. It can roll to a financially dependent child or into a disabled child's disability savings plan. But the spousal rollover is the big one, and it's automatic if you've named them properly. But here's the twist most people miss, and it's the whole reason planning matters. That spousal rollover doesn't erase the tax, it just delays it. When the second spouse passes, the entire thing gets taxed then. So the bomb isn't diffused, it's just moved down the road to the second death. Remember that, we're coming back to it. So that's bomb 2, the RRSP, the biggest one for most families. We'll fix it later, I promise. But there's a third bomb, and this one depends entirely on something you might not expect: which province you happen to die in. Bomb 3 is probate. Think of it as a fee the government charges just to make your will official, before your family can touch a thing. It's a percentage skimmed off the top of your estate. And here's the wild part: what you pay depends almost entirely on which province you live in. I call it the province lottery, because the difference is honestly ridiculous. Same exact estate, same $2 million, 3 different provinces. Watch what happens. The number swings by tens of thousands of dollars just based on a postal code. In Ontario, on a $2 million state, probate runs about $29,000. In British Columbia, it's close behind, around $27,500. And in Alberta, $525. That's not a typo. $500 flat. Why so cheap? Alberta treats probate like a simple filing fee, and it caps out at $525 no matter how big the estate is. Ontario and BC charge a percentage with no cap. So, the bigger your estate, the more they take. Same death, very different bill. Now, while we're talking about what passes to who, let me save you from a trap hiding in your TFSA. When you set it up, you can name your spouse one of two ways: successor holder or beneficiary. They sound the same, they are absolutely not. Name your spouse successor holder, and the entire TFSA just becomes theirs, fully tax free. And it doesn't even touch their own contribution room. Perfect. But name them only as beneficiary, and any growth between your death and the payout becomes taxable. Same person, worse outcome, just because of one word on a form. Okay, three bombs: the cottage, the RRSP, and probate. You'd think that's the whole story, but there's one more thing, and it's the mistake that quietly does the most damage of all, because it stacks every bomb we just talked about into one final hit. Let me show you the second death trap. Here's the trap that catches even careful families. When the first spouse dies, everything rolls over tax free. The cottage, the RRSP, all of it slides to the survivor. No bill. Everyone breathes a sigh of relief and stops thinking about it. That relief is the dangerous part. Because when that second spouse passes, there's no one left to roll anything over to. So now everything detonates at the same time. The cottage's full gain, the entire RRSP taxed as income in 1 year, probate on the whole estate. All three bombs, one final tax return. Stack it all up on a typical estate: a paid off home, a cottage, a healthy RRSP, and the combined hit can easily reach $300,000, $400,000 or more. Remember Sarah from the very start? This is exactly what that piece of paper said. A third of everything, gone. And look, I'm not telling you this to ruin your day. I'm telling you because almost none of this is set in stone. Every single bomb we just walked through can be shrunk, delayed, or in some cases, wiped out completely, legally, with a little planning done ahead of time. So let's flip this. From here on out, it's all solutions. 12 of them, going from the stuff anyone can do for free this week all the way up to the moves for people with cottages and businesses. And that free 10-minute fix I promised you at the start? It's first. Let's diffuse these. Tier 1. Free. Do it this week, and honestly, the most important stuff in the whole video. This is the 10-minute fix I promised. Pull up every account you've got: your RRSP, your TFSA, your pensions, your life insurance. Check who's named as the beneficiary. Here's why it matters so much. If you name an actual person, your spouse, your kids, the money skips probate entirely and goes straight to them. Name no one or name your estate, and it all gets dragged through the courthouse, taxed, and delayed. Same money, wildly different outcome. One free form. And remember that TFSA trap? Here's the fix. If you're married or common law, make sure your spouse is listed as successor-holder, not beneficiary. 2 minutes with your bank. While you're at it, double check these after any big life change: marriage, divorce, a new kid. Outdated forms cause nightmares. One more free move, but with a big warning label. Putting a bank account or home in joint names with right of survivorship lets it skip probate. Between spouses, usually fine, but adding an adult child, that can backfire badly. Courts may treat it as part of your estate anyway, and it exposes your asset to their divorce or their creditors. Talk to a pro before doing this one. Tier 2 takes a little planning. First, the big one for anyone with a cottage or a business: life insurance. A policy sized to match your future tax bill means the cash is there to pay the CRA, so your family never has to sell the cottage to cover it, and the payout itself lands tax-free. And here's the clever bit for couples. A joint last-to-die policy only pays out when the second of you passes, which, remember, is exactly when that big combined tax bomb goes off. It's cheaper than two separate policies, and it's timed perfectly. Just buy it while you're younger and healthier, because it gets pricey fast with age. Next, if you own a private business in Ontario or BC, ask a lawyer about having two wills. One handles the stuff that needs probate, and a second one quietly handles your private company shares, so they skip the probate fee entirely. On a few million in shares, that can save tens of thousands. Alberta folks, you can relax. Your fees are tiny anyway. If you're charitably inclined, this one's beautiful. Donate stocks or funds directly to a charity, in kind, and the capital gain on them is wiped out completely, zero. Plus, your estate gets a donation credit that, in the year of death, can offset up to 100% of your income, and you can carry it back a year too. Generosity that also slashes the tax bill. Tier 3, the advanced moves. Talk to a pro for these.
The big one is the RRIF meltdown. Instead of letting your RRSP balloon until death, you deliberately draw it down in your early retirement years while you're in a lower tax bracket. You pay some tax now at low rates to avoid a giant bill later at the top rate. This pairs perfectly with delaying your government pensions. Hold off on CPP and OAS until 70, and they grow substantially. CPP by over 40%, OAS by more than a third. That gives you a window of lower income in your 60s, perfect for melting down that RRSP cheaply, and it helps you dodge the OAS clawback too. If you're 65 or older, there's also something called an alter ego trust. You move assets into it while keeping full control during your life, and because they're technically not in your estate when you die, they skip probate entirely and stay private. There's a couples version too. It costs money to set up, but for larger estates, it can be well worth it. And for business owners, the estate freeze. You lock in your company's value at today's level, so your future tax bill is capped right now, and all the future growth shifts to your kids. Pair it with the lifetime capital gains exemption, which shelters over $1.25 million of gain on a qualifying small business, and the savings can be enormous. Put even a few of these together and you completely change the math. The family that does nothing hands a third of everything to the CRA. The family that plans, they keep the cottage, they keep the savings, and they pass on what they actually meant to. Same assets. The only difference is a little planning. Okay, let's lock it in. 3 hidden bombs when you die in Canada. The cottage and investments, taxed as if sold, the RRSP, counted as income all in 1 year, and probate, the fee that depends on your province. No inheritance tax on paper, but a very real bill underneath. And if you do nothing else after this video, do this one thing. Go check your beneficiary designations this week. The single most expensive mistake families make is also the one that's completely free to fix. 10 minutes, that's it. It might be the highest value thing you do all year. Now I want to hear from you. Drop your province in the comments and I'll tell you what your probate situation actually looks like. Because as you saw, it ranges from $500 to tens of thousands. Are you in a cheap province or an expensive one? Let's find out. And if this saved your family even a fraction of what it could, do me a favor and subscribe. Every week, I break down Canadian money, taxes, and retirement in plain English, so you keep more of what you earned. The CRA is not going to explain this stuff to you. That's my job. If you found this useful, I've got 2 more that pair perfectly with it. One on the exit tax if you ever dream of retiring abroad, and one on the single CPP rule most Canadians get wrong. They're right there. I'll see you in the next one. Take care of your people.